Hello and welcome to Switzer TV. I'm Peter Switzer. Thanks for joining us. And today I want to look at three tech-oriented stocks that have underwhelmed. Their share price has not performed as well as we'd like, but the analysts still give them a real decent thumbs up. These three stocks are Megaport, Audinate and Tyro. Now, Megaport gives businesses extra website capacity during busy times. Like right now, the VRC would need a lot more power and capacity on its website because of the popularity of the Melbourne Racing Carnival. Audinate uses its technology to help sort of rock concerts and major events, football grand finals where there's large crowds, and they need like a private communication system. They compete with Bluetooth. It's a private version and a rival to Bluetooth. And then there's Tyro, and you often see them when you go to cafes and restaurants where you often find that the FPOS machines are a Tyro machine. Now, the analysts believe that there's a 64% upside for Megaport, a 35% jump for Audinate, and a whopping 99% spike for Tyro. That's if these guys are right. Let's just see what Michael Wayne of Medallion Finance has to say about these three stocks, and then we'll talk to Adam Dawes of Shaw and Partners. Michael, thanks for joining us.
Thanks for having me as always, Peter.
All right, mate, you're the perfect person to talk to because you are the guy who introduced me to both those stocks, Megaport and Audinate, and I know you have a view on these. So let's kick off with Megaport first of all. Has disappointed, has been a much higher valued stock, well over $20 at one stage, and now it's under 10. What's your current take on Megaport?
Yeah, so Megaport's one I probably introduced to you going back a number of years now, sort of 2017, 18.
Yep.
And it really had a very good run there for a number of years when it was really an unprofitable business. Since then, it's made a transition. It is a profitable company. However, although they met expectations for FY24, the FY25 guidance underwhelmed the market considerably. It's not a business we've held for 2 years until very recently. So we've recently retaken a stake in this position, in this company. We believe that sentiment has become overly pessimistic. And although looking forward, they're going through a period of consolidation, if you like, there are a few adjustments that management are making to their pricing structure, which we think will flow through in the second half of FY25, and the company can start to see that nice recurring revenue start to pick up again. But we think it's a quality business. It hasn't been doing things by halves, with recent reports either being very, very good and the market jumping 20% or so, or very, very negative and then falling considerably off the back of that. But I think the quality of the business remains. It does have first mover advantage. It does give you access to Amazon Web Services, Google Web Services, the IBM Cloud, and effectively allows businesses to dial up and down their data usage as required, regardless of their geographical locations. So it's one that we are initiating a position in at the moment as we speak, kind of thing, sort of topping up every now and again, because we do still like that long-term story.
Okay, so when you first introduced me to Megaport, one of the points you made was it didn't have any serious rivals out there at that point in time. What's the competition like nowadays?
Yeah, so there is a few new rivals that have emerged in recent years. And at one point, Megaport was the cheapest. In recent times, they're no longer the cheapest. However, for the new customers that they're bringing on, there's a couple of fees that they've adjusted to reassert their competitive dominance. And we feel as though that's going to help them recover in the months and years ahead. So yeah, there definitely is competitors that have emerged, but none have the scale of Megaport, and none have the offering whereby, providing access to a variety of databases, some of which I just mentioned, that, some of their competitors can't provide. So there definitely is a growing competition. They have had their competitive position eroded a little bit through some pricing initiatives of some of those competitors, making Megaport less attractive on price. However, there are services and there are access benefits to using Megaport, which are entrenched. The other thing that Megaport has been shifting in recent years is less of a focus on winning over new businesses or new customers, but rather looking to upsell existing customers. And that has been a bit of a a challenging or disruptive process, and that's why I think the markets struggle to get a good read on the outlook for Megaport's revenues and earnings in recent years, hence the large gyrations that we've been seeing around reporting seasons.
Okay, I always like to invest in the best company in the sector. Does it qualify as the best company in the sector?
In our view, absolutely, that's still
Okay.
definitely the case, and that's a similar characteristic that we would share, that you want to be with the market leader, and I think Megaport ticks that box.
Okay, let's go to Audinate now. Another interesting business, and I don't think they really had much of of competition when you first introduced me to Audinate. What's your current view on Audinate?
Yeah, so Audinate's one that we've held for a number of years now, probably 2020, around that time, if not even before. And it's basically gone sideways over that time. It looked very good going back 6-12 months, started to break out. It turned cash flow positive, turned profitable as well. So made that transition very nicely. However, the market to some extent got ahead of itself. It basically looked at the numbers that they delivered in FY24 and assumed that that was the new norm for this company. However, as it turned out, there was an enormous backlog post-COVID, which the company inflated their revenue numbers and earnings growth numbers as well. So the markets had to digest that. Perhaps this company wasn't going through the explosive growth phase that it might have appeared on the surface. So FY25 is going to be very much a consolidation period for the company. I think the market's fully understanding that now, hence why their recent profit downgrade as of last week didn't see the vicious response that you might have expected for a profit downgrade of that magnitude. So I think sentiment's pretty well negative on this, but it's very much a 2026 and onward story. So the business is still the most dominant in the space. It's growing, and its competitive position is extremely dominant. It's growing at, I think, 12 times the nearest competitor. 80 to 90% of new electronics products coming to market incorporate the Audinate Dante protocol, allowing different pieces of equipment to communicate with each other without the needs for cords and cables. So it's by no means a horrendous situation at all. It's merely a company transitioning through a backlog, if you like, pulling forward the benefits of clearing that backlog, and now things are returning to a more normalized state of growth. So we feel that this is, again, pretty much a monopoly in its space. They've released different products to the market. They're also adjusting their pricing model, which will give them more of a SaaS, subscription as a service, recurring revenue model going forward. So there's a lot of quality things to like about this business. It's just that we, as well as a lot of others in the market, got too excited about their explosive growth numbers from last year, which were, as it turned out, more one-off in nature rather than permanent. However, that long-term growth trend remains intact.
Yeah. So the one-year consensus view from analysts of about, I think, around 30% upside doesn't look too unrealistic to you?
No, I mean, they've obviously adjusted those even lower in the last week. So yeah, a couple of weeks ago, those upside figures were a lot higher.
Yeah.
The market is not very good at looking long term. It struggles to digest the long-term narrative when the short-term news is so poor. And it's a couple of sort of negative updates from Audinate, which have everyone down and out. But all it takes is a strong second half of this year, and things can very quickly be ratcheted up on the analyst front.
Okay. When I first introduced these companies, to me, they look like up and coming tech companies. I looked at companies like NextDC and Xero and saw them as being quality tech companies. I think their share price and performance has kind of reflected that. I have this suspicion that both Megaport and Audinate are moving into from that up and coming to becoming quality tech companies, but it probably just needs a year or two to prove it.
Yeah, that's absolutely right. I mean, we call them sort of emerging leaders, these companies that are in inflection points whereby they're going from loss makers, where often the share price will still do well, even though they're loss makers because of the hype around the story. But then when it comes to actually making that transition from a loss maker to cash flow positive, earnings positive, there can often be a little bit of a hiccup, or maybe that transition doesn't happen as quickly as the market initially thought. Nevertheless, that transition is still happening. It just might take a year or two for that to be embedded and to become the norm as the company really starts to build on the extreme, growth margins or gross margins, sorry, that they have. In the case of Audinate, they've got an 80% gross margin. They're looking to get that up to 88%. So it's a very high
Yeah.
margin company. So as that revenue growth starts to pick up, a lot of that revenue growth is just going to flow straight through to the bottom line. And that story or that thematic is still playing out. It's just more of a 2026, 2027 story when the market was sort of factoring in that all playing out in 2025. So where we still try and look, 2-3 years out, and although it's not as fast as the market was initially expecting, we still feel as though they're going to get there.
Okay. Now, the third company, and I don't really recall whether you've been in Tyro's camp or not in the past, but seeing its fall into the 77, 78 cent region after the federal government talked about taking away fees on debit cards, it looks like to me it's in the buy zone at this particular price. But what's your reflection on Tyro right now?
Yeah, so our view at the moment is we think it's very, very cheap. The hospitality sector has been struggling, as I sort of touched upon. They do have a bit more churn of customers than the market would like, but that's, again, a symptom of the environment we're in. However, gross merchant additions has been accelerating, which I think is very positive. Gross margins have been very good as well. So it's a company that looks quite cheap and it has a margin of around 30%. So if the environment improves somewhat for them, I feel as though this is a company that screens cheap and could well see a bit of buying come in, particularly once the horizons clear up a little bit around merchant payments, but also around the hospitality sector. So I've got a tentative value buy on this one.
Yeah, I've been told that the impact of these debit fees is not going to be as serious on the bottom line for this business. I also think lower interest rates will help them, and you make the point with lower interest rates, that's going to help demand, and the hospitality sector will start to improve. So my way of thinking, if you're going to get this at 78 or 80 cents, believing it could get to $1, given the fact that takeover amount was about $1.60, seems like a reasonable speculative play.
Absolutely. I mean, they've set FY27 targets, and that's not typical of management. Often management would prefer to not set long-term targets if they don't have to, or unless they're very confident in that outlook. And management, in order to hit that target, need to deliver 15% earnings growth compounded for the next few years. And if they're able to achieve that on these multiples, it is an attractive business given the valuation on offer.
Yeah. And it also is a bank, and it really hasn't exploited its relationship with small businesses, which I think is something they should be thinking about. Michael, as always, thanks for joining us. Great insights, and I look forward to talking to you in the future.
Thank you for having me, Peter. Have a good day, everyone.
Yeah, that's Michael Wayne of Medallion Financial. And now we're going to catch up with Adam Dawes of Shaw and Partners to talk about the same stocks and a few other ones that he might be interested in. Welcome to the show, Adam.
It's great to be here, Peter. Thanks so much.
Now, I've talked to Michael Wayne before you about 3 stocks that are relevant to lots of my clients on the Switzer report. They often ask me when we do Boom, Doom, Zoom, which you've featured in. And there are 3 stocks that I hold as well. And you know, I've often asked you about Tyro, Megaport, and Audinate. But they are interesting companies. The point I made to Michael Wayne earlier was that say 5 or 6 years ago when I first bought these stocks, I saw them as being up and coming tech stocks. I think now they've got a bit of quality about them, and they're sort of progressing to being like great companies like NextDC and Xero. It still might take some time, and they may well prove it over the next couple of years. And that's why I want to talk to you about, the view on, you can give the short-term view on what happens to the price, but where do you think they might be in 1 or 2 years' time? So let's kick off our first one, namely Megaport. What's the current house view and your view?
Yeah, look, it's an interesting one because it's one of those market darlings that should have done a lot better than what it has. And it continues to somewhat disappoint investors. But if you talk to any fund manager, you talk to any sort of really sophisticated investor, they love this stock. You know, they really do. They think it's absolutely fantastic. So I've got a couple of things that, you know, sort of Megaport has to sort of, there's some hurdles that they need to jump over to really get that. And, you know, I think over time, I think they will. But overall, Megaport definitely needs to show that it has the ability, and it's about the sort of cost overrun. There's a little bit of that cost overrun going through at the moment, but I also see that Megaport, it needs something. You know, the market doesn't seem to grasp it at the moment, and it just really needs to show the market that it can, one, provide revenue, but then two, to become profitable. And I think that is the biggest key for this one. Look, it's a tough one because every kind of announcement they have, it sort of jumps a little bit, and sort of, you know, we think this thing is going to move, and then it just continues to slide lower going from there. So I think it's something for the people that have the confidence that they're going to hit their numbers, and I think from there, listening to their AGM, I think is probably going to be the next port of call for me on Megaport, just to get a bit more comfort around it. At the moment, it's certainly something that I wouldn't put my 80-year-old grandmother in. I think you definitely need to be a little bit cautious, and this is more of a growth stock, which means that it's going to be a little bit tougher, you know, going forward.
Yeah, it just seems to me it's a company that's going to benefit from a more globally positive economic environment,
Yeah.
lower interest rates, and all those sorts of things. So it probably makes sense that it's languishing. It just, to me, looking where the share price has been in the past and where it is now, it does look like, for someone who doesn't hold it at all, it must be in the buy zone, particularly if you're happy to wait 1 or 2 years for some, yeah. And all the analysts like it, Adam, from what I can see.
Yes.
They like it quite a lot. So let's go to the next one, Audinate. And I think Audinate's a similar kind of company, best of breed in this industry, hasn't performed great. By the way, both these companies, their management are quite happy to tell the truth, even when the truth is not all that great.
Yeah, I agree. And that's what you want from a company. You don't want anything hiding. You don't want a wise tech, or you don't want a Min Resources just popping up on you, and then all of a sudden there's issues. Yeah.
Remember Nuix? The classic case.
I do remember Nuix very, very well. Very well. So looking a little bit better now, Nuix. Looking a little bit better now. But yeah, so, you know, I think Audinate overall, we're really looking at that video side of things. That video side of things really needs to start to fire. It's a lower margin part of the business, but it is something that these guys can roll into and actually sort of do quite well. The last quarterly that came out, the market again punished it on the back of, and it was quite interesting. On that day, it got punished, but it got bought up pretty quickly. So that does show to me that there is some support there. There is some buying that's in this stock. Any kind of hiccups, I think that will do well. It's one of those ones that I own in my super fund at higher levels, but I do feel that this one has the ability. It hasn't lost its market darling status. I think it's a little bit tarnished at the moment, but I still think people still feel this one has got a lot of room to move. And if they can get that video side of things moving in the right direction, I'm really comfortable with one. Again, it's one to stick in the bottom drawer and wait a couple of years.
Yeah, when I wrote my story for the Switzer report today, the view was, if I'm holding it like you know, is it at a price where dollar cost averaging might make sense, only for the speculative part of your portfolio, or if you're not in the stock, is it a reasonable entry price? And I think both of those I tick the box on for, you know, as I say, as long as you're not going too madly into it, I think they will be pretty impressive companies in 2 or 3 years' time.
Agree.
Now let's go to another one, Tyro. Now, yeah, you know, I know, it knocked back a takeover of $1.60. Last time I checked, it was about 78 or 79 cents. I don't know what it's done today. And also, of course, the last drop, about 11 cents, happened because of the federal government talking about taking away debit fees. And I've been told that the debit fees aren't going to be have a material impact on the business. So where are you on Tyro at these current share prices?
Yeah, so I think if you look through that government sort of taking away that 10 cents, 15 cents, you know, you still need to tap somewhere, and that's where Tyro comes into that space. I mean, every time I look, when I'm tapping, I'm always looking, is it a Tyro one or is it a bank one? Or is it, I'm sort of trying to, in my head, doing a bit of math on sort of who's got the most market share. And Tyro definitely for me seems like they've got that market share out there. And it seems like it's a really simple product that they're offering. I think overall, it's annoying that they rejected that. They potentially saw that there was more for the business. And overall, Tyro is going to continue to do well because cash is non-existent. Like I've got cash in my wallet, but I don't use it anyway. So
Yeah.
I think Tyro overall has a fantastic business. It's hardware. It's in the marketplace at the moment. So it's all about taking market share. And I think overall the banks are probably languishing a little bit on that market share. So I think they should be able to take some more market share out of that. I think the headlines didn't do it justice when the government turned around and said they're banning that sort of 1% fee or those kinds of things, which I think is absolutely justified. But that doesn't hurt Tyro because they have the machine and they take a fee out of that. So I'm really comfortable with Tyro. It does look like it's a little bit oversold at these levels, but they just have to keep coming out to the market and telling us that things are okay. And I think this one should do okay or do all right.
Yeah. Yeah. I'm just kind of thinking that, okay, if I buy at 80 and it gets to 90, well, that's 12.5% return. If it goes back to $1 during an enthusiastic time of the market when interest rates are coming down, and they must have a lot of borrowed money as well, where interest rates are relevant. If it gets to $1, that's 20 cents on 80, 25%. Yeah, that's worth a punt, I reckon.
Oh, I agree. Absolutely.
Okay. They're the three I want to talk about. What have you got? What have you seen lately that you like?
Yeah, well, I'm just looking at the supermarkets. Potentially everyone might be saying that's a little bit boring, but we do have the quarterly sales coming out for Woolworths. I think it's on the 30th of this month. So, and then the 31st is Coles. So basically looking at the supermarkets as far as that, look, they've got a lot of market share. Is that good for competition? Well, probably not, but it does depend on how you look at it. Certainly Metcash gets put into that one as well. We are forecasting sales for Woolworths to be around about $7.8 billion or 3% above the previous corresponding period. And we're looking for Coles to be around about $10.3 billion, which is about 2.9% above previous corresponding period. So it does mean that they are moving within their margin. Now, there is certainly the ACCC action that's happening against them at the moment. And shorter term, I think that's providing us an opportunity to get into these things because longer term, I don't think that that's going to be too much of an issue. And look, is it a good investment? I think everybody should have consumer staples, bread, milk, and cheese in their portfolio, Woolworths or Coles. I prefer Woolworths over Coles. I think Woolworths is a better business, better run business. But overall, look, looking for those supermarkets to give us that sort of 3% growth going forward. I know it sounds a little bit boring where we just talked about Megaport, Tyro, and Audinate, but I think overall it is part of a portfolio, and that part should certainly be in those consumer staples because these guys are not going out of business and will do well over the medium to long term.
Yeah, and last week Metcash got slugged.
Yes.
Does that make it more of a buying opportunity, or was there a substantial reason for that slugging?
Yeah, I think it was all about the Mitre 10, the hardware division of Metcash. And Metcash certainly is the number 3 player in the 4 players, which is Aldi, Metcash, Coles, and Woolworths. I think overall, I wouldn't be buying into these results. I'd be waiting for these results because potentially, yes, there might be some further downside. But that then again provides opportunity. I think Metcash is a good business, but it's certainly the third fiddle in their relationship, as well as they are more expensive than Coles. And I think if you're coming from this sort of cost of living issues, then people are looking for those extra 10 cents, 20 cents, $1 here. And I think Metcash does suffer from that IGA side of things. So Woolies is probably number 1, Coles 2, Metcash 3, and then you can't invest in Aldi unless you go to Germany. But yep, that would be my recommendation.
Okay, I got to say the very thought of you with that purple tie of yours in a Coles or Woolworths aisle pushing a trolley, I just can't see it, but I'm laughing at the very thought of it.
I'm going to take a photo next week, and I'm going to wear this tie, and I'm going to put it on just for you and the viewers.
Okay, fantastic. Thanks for joining us, mate.
Thank you. It's great to be here.
Yeah, that's Adam Dawes of Shaw and Partners. And that's the show for this week. Now, don't forget, if you want analysis, more analysis, and expert views on companies that have upside or even downside, think about signing up for the Switzer Report. You'll get 3 newsletters a week. You can tune in and ask questions in the Boom, Doom, Zoom webinar on Thursdays. And each week we answer questions from clients in the newsletters themselves. The cost is $397 a year. And for many of you, it will be tax deductible. Thanks for joining us. I'm Peter Switzer.